Welcome to the Political Risk Podcast, where insurance and geopolitics meet. I'm your host, David Benyon. My guest for this episode is Eran Charit, a senior broker at Lockton Re. And our topic is a perfect storm for credit and political risk reinsurance. From Eran's vantage point as a reinsurance broker of credit and political risk business, we discuss some of the dynamics within the CPRI space, including a raft of new market entrants at primary level, bringing with them an influx of fresh capacity, and the soft market conditions that tend to accompany supply overmatching demand. We contrast the number of insurance entrants with a lack of reinsurers that are leaders rather than followers for risk transfer at treaty reinsurance level within the same class, creating conditions where a sudden exit of a leading reinsurer could cause a capacity crunch. This being the Political Risk Podcast, we also focus on some of the systemic risks that are faced as a result of all these factors and the underlying risk environment, particularly systemic risk shocks that might arise, perhaps from a large fraud being uncovered at a large retailer or energy company, or a cyber attack outage hitting an exchange or payments provider, or striking down critical infrastructure in an emerging market country. Eran brings great perspective to all this, having first served as a broker at primary level at Aon and Gallagher, before making the jump to become a treaty reinsurance broker at Lockton Re. At which level, the same risks within an insurer's book of business, bundled together at portfolio level, are transferred on to reinsurers. So this episode is an eye-opener for a part of the specialty insurance and reinsurance market that is perhaps not quite so well understood as some others. Enjoy the conversation. Well, Eran, thanks for joining me on the pod.
Thanks for having me.
Great. Well, I thought we could start off with you explaining just your role at Lockton Re to begin with, and how your background in the direct market before that informs the way you work in reinsurance broking at treaty level.
So I'm one of the senior brokers at Lockton Re's specialty team. My primary focus is all things financial risks, which is an all-encompassing term for all things credit and political risk. We tend to split it into, if you will, subcategories. It covers what we call the Lloyd's structured credit market. So that's what Lloyd's syndicates write in terms of credit and political risk. It also covers whole turnover credit, which is short-term sales, things such as sales through Tesco and somebody buys on credit terms and Tesco then pays them back within 60 to 90 days. That is a part of the industry which is dominated by three large insurance companies, Allianz Trade, Tradius and Coface. We also cover surety. That's another element of financial risk, which is where effectively an insurance company provides a guarantee rather than an insurance policy, if you will, to either government entities or contractual parties. And then we also cover from time to time mortgage. And the latest thing in the market is SRTs, being significant risk transfers, which effectively are bank portfolios who are buying holistically across a portfolio rather than individual transactions. Political risk, if you will, within the payment element of the risk is all-encompassing. So a non-payment insurance policy effectively covers any non-payment for any reason whatsoever. So if there's a political element leading to a credit event, so for example, let's say a government decides to stop all hard currency transfers. Let's say the Argentinian government says no dollars can leave the country. That would be seen as a political risk element because it's a political action taken by the government, which then led to a credit event or credit default.
And for your purposes as a treaty reinsurance broker, is it all packaged together in the same treaties?
So we don't really try and distinguish between political or credit risk. The one thing we do look at is what Lloyd's codes as PR. So that's effectively what people know as C&D cover or confiscation covers, where you might have assets in a foreign country and you're an investor, and then the government decides to confiscate that asset. So there isn't a credit element per se to that. That's a pure expropriation risk. A good example is what happened in Russia. So if you will, you had a lot of foreign companies having assets in Russia. And then when the war kicked off, they've decided to pull out of Russia. Now there is a claim in the market, in effect, talking about political risk losses.
What's been the story at Lockton Re for broking this business at reinsurance level?
If you look at us as a company, we were set up 5.5, 6 years ago. We call it Lockton Re 2.0. So you had an existing treaty team sitting within Lockton, which focused mainly on casualty. And then when there was the acquisition of JLT by Marsh, there was a decision at Lockton level to effectively expand our offering into wider product lines in all things reinsurance. That's when we started hiring from other reinsurance brokers. Specialty as a division was set up now 5 years ago. And the one thing that distinguished us as a team is all of us have come from the direct market.
So when did you make the move?
Coming to 4 years. So I was a broker prior to that. So I started at Gallagher's on the structured credit team. Then I moved across to Aon, and I was still on the direct side, sitting within the whole turnover credit team, but effectively cross-selling structured and surety solutions to the Aon client base. And then I joined Lockton and switched to reinsurance, still within the same class.
It might be good to just give a bit of a more basic explainer in broad terms about your role as a reinsurance broker.
Quite often I get asked, what's the difference between insurance broking and reinsurance broking? And the way I think about it, it's a difference between, if you will, tactical broking and strategic broking. So on the insurance side, you mainly sort of a tactical broker. So you get presented a specific risk, you go to market, you find a home for it, and then you move on, right? It's very transactional based. So you're just moving from one risk to the other. When it comes to reinsurance treaty broking, it's much more of a holistic view. And it's much more about how do you understand the company's objectives, goals, what it is an insurance company is trying to do, the direction of travel, and then you trying to find the most appropriate structure on a treaty basis to then help them grow and direct the book in that direction. The way I look at it is, as a reinsurance underwriter, you're letting another underwriter borrow your balance sheet. You're effectively saying, I believe in the way you underwrite. I trust your judgment. I trust your pricing. Here you go. I'm going to support you. Because reinsurance is much more about long-term partnership, smoothing the rough years with the good years. It's much more of a symbiotic relationship, whereas insurance tends to be much more of a discretionary purchase, right? This is not a compulsory class. So when people are coming to the market and buying it, they're not looking at their entire portfolio necessarily. They're just looking at the spicy risk and trying to get them off their balance sheet.
Well, let's talk about market dynamics for a little bit. So the reinsurance market for political and credit risks is relatively concentrated. So Hanover Re do this business, Liberty Re, and a few others, but it's not a massive list of carriers. So how does that overall situation affect things like capacity levels and competition?
I think that's a great question, because what I didn't realize until I switched to reinsurance is you might have a very broad spectrum of insurance operating the space, but it all tends to go back to a handful of reinsurers. So if there's about 60 odd potential candidates who operate in this class, potentially more if you look at all the subdivisions, let's call it 100 odd. On the reinsurance side, you have a lot less than that. And even then it's highly concentrated with, say, less than 10 who probably control, I would reckon 50-60% of the entire reinsurance capacity out there. So you've got the same insurance underwriters fighting for limited capacity available from a very few handful of reinsurers out there. So you have this strange situation where you effectively got the tail wagging the dog, where reinsurance are not quite kingmakers per se, but they can very much dictate how much capacity and underwriting authority indirectly an underwriter has on the front end.
While we're at it, where are we in the cycle? I mean, it's a soft market for most reinsurance lines of business at the moment. Where would you say credit political risk sits within that?
We're in probably the softest we've seen it for about a decade. And it's a combination of great results the last 5 years. So what we have seen is, despite everything that's been going on, quantitative easing and Western governments printing money effectively meant that there's been no credit events and no insolvencies. So results have been phenomenal. We're talking about 20, 30 points below historical average, right? So if the market is running on a loss ratio between 50 to 60, since 2021, we're looking at 20 to 30.
At insurance level, we're seeing that not just in terms of existing carriers deploying more capacity, but new entrants too. So is it 2 new Lloyd's syndicates doing this business just in the last few weeks? Or maybe it's a month or two now, time flies.
We have just heard unofficially that both Atreides and Coface will enter Lloyd's next year. That is very much driven by the Lloyd's credit rating, because Lloyd's having achieved a AA rating is very, very critical for this class, where you have buyers of the product using credit rating for capital relief, specifically the banks. That's a whole sort of story we can cover. But to your point about, capacity, what we're really seeing is on the back of the really strong results and people looking to diversify away from property cat, there's just capacity coming to the market from all directions. Specialties in vogue.
It's the same story in PVT to some extent. It's a diversification play, but then everybody makes the same diversification play and we see rates soften, and is paradoxical to the risk environment where we're seeing, for that line of business anyway, a very elevated risk environment.
I agree, and I think that's because the development pattern for this class is slightly different to traditional property lines, right? So you start writing property, and if there's a fire, you get hit and you know where you stand. And this class usually takes anywhere between 2 to potentially even 20 years until the loss is actually materialized. I mean, we still have court cases going back from the 80s for Iranian losses, right? The tail is very, very long. So what you're probably seeing at a top level, it looks like a very lucrative business because there's premium growth, no losses to date yet, great results. What we're expecting to see a shift in the market the next 24 to 36 months when the losses are going to start coming in. And that's going to help sort of like, you create a perfect storm where you have lots of capacity coming to the market, pricing is being driven down, and at the same time, you have a heightened risk environment and more losses.
And are there any reliable estimates out there in the market or your own for the size of it at the moment?
In terms of the size of the market or losses?
The size of the market.
We tend to use the Lloyd's triangles as a proxy for that. So if you look at specifically the Lloyd's market, there's about 3 to 4 billion pounds of premium. If you look at the entire financial risks market, which includes, again, the other lines I mentioned before, we talk about $50 billion across the world.
What's the graph look like for that? Is that quite spiky?
In terms of growth?
Yeah.
Well, the only time we saw a drop was post-global financial crisis, where reinsurers sort of retrenched. So there's, if you will, there's a small dip between 9 to 10, but has been steadily growing year and year and year. We're talking about 10% annual growth. And that's very much driven by the banks.
And the pipeline for future growth in terms of how many syndicates perhaps haven't launched but could be in the pipeline at Lloyd's?
Oh, I mean, quite a few. This is again on the back of the credit rating upgrade at Lloyd's saw 2 years ago now, I think. And if you will, there's a lot of capacity looking for return out there. It's a soft market, specialties in vogue. So we're probably talking, I can easily see another 4 or 5 syndicates stepping into the foray and offering the capacity in the next 12 to 24 months.
How do reinsurers evaluate credit risks that might have underlying political elements to them, such as exposure to shifting trade policy or supply chain disruption?
What you tend to see reinsurers think about is, again, they think holistically about a portfolio. I mean, quite often we get questions from the reinsurers going, how does your client view the trade war? How does that impact either the pricing or potential heightened increase for losses? What's the view? We're not looking at individual transactional level. We're taking a step back and going, right, let's have exposures in China, have exposures in Asia, have exposure in Europe. How is the whole thing interconnected, and how could the closure of the Strait of Hormuz impact your portfolio as a whole?
Trade policy and President Trump coming out with new tariffs from one week or month to the next. I mean, the main link to that and your business, is that just heightened counterparty credit risk?
Yeah, but also creates opportunities. Because if you think about it, what might be happening is shifting trading patterns. So let's say on the back of these higher tariffs, there's going to be less sales into the US and out of the US. People are still going to produce goods. They might not need to sell it and shift it to regions they're not familiar with. So they might come to the insurance market and go, look, I'm now entering new territories. I don't necessarily have the experience dealing with this. Can you help me, Mr. Underwriter? So it's a classic case of, it's both an opportunity and a threat. And the underwriters continuously just monitor the situation. They have their finger on the pulse. But at the same time, I would say they're not panicking. This is just the latest iteration of an over-evolving risk environment.
So speaking of opportunities, are there any new types of buyers or new locations of buyers that wouldn't have really figured before, but now do in this new environment?
We've seen an increase in buyers in the Middle East coming to the market. So as Middle Eastern, Saudis, Emiratis, financial institutions and corporates are becoming more sophisticated, they definitely come to the market, which wasn't really a thing before. We are also waiting for the Americans to start use the product more heavily, but that's been a thing for forever. The penetration for this product in America is extremely low compared to other parts of the world. They have a higher risk tolerance, so they're they're much happier, if you will, or more willing to take political and credit risk than, say, European parties. So we don't see a high penetration out there. We are waiting for potential regulatory shifts when it comes to the banking environment, because at the moment, European banks buy predominantly, again, for capital relief purposes, which helps our own lending activities. At the moment, it's not a thing in the US, but that might really change.
So, Eran, for underwriters at reinsurance level, what role does methodology play in how they might view and differentiate between the ceding CPRI insurers and their different books of business?
I think, we have seen a harmonization of the way that people underwrite. So you have effectively standardized credit models, a lot of people using the same third-party information providers. There is a bit of a risk of groupthink. So what reinsurers are really looking for is to see if anyone has a very specific USP. Now, that could be a regional focus, that could be product focus, really to distinguish what makes a specific cedant a more attractive proposition and have the right, if you will, know-how and tools to outperform the market. So what we have seen on the insurance side is what I call the bifurcation of the market. So if I think about the market 10 years ago, books were quite similar. People were just following each other. There was a relatively consistent list of risk being insured, and it was just basically down to what line size you had to what market share you had. You now see lots of subcategories within even the credit and political risk space, to the point that you see different underwriters specializing in subcategories. And I think the next logical step in our market is to see the prevalence of consortiums, because they're not really a thing in this market just yet.
Well, I suppose there's all this new capacity coming through and still coming through the next year.
Absolutely.
So that would be a next step then.
Yeah. And I think, again, because...
Would that count as innovation, I suppose, in this space?
Well, I wouldn't say innovation in the traditional sense, because it's more of the same, but from a client's perspective, it would be a much more attractive proposition. Because at the moment, trying to get a deal over the line as a broker on the front end, you need to run around the market and speak to, 20, 30 parties. Whereas if you had a consortium, you might end up just with one or two, just reducing transactional frictions.
Yeah.
On reinsurance level, you have much more of a lead follow market. So on insurance, it's not really a thing. Everyone underwrites a transaction independently. No one really follows each other. On the reinsurance space, you very much have a lead follow mentality, where the leads dictate the terms, the structure, and the policy wording, and then the follow markets follow suit. Having said that, we're desperately in need of more leads. There's just not enough leads in our market.
Earlier on, we touched on capacity being concentrated among a relatively small number of treaty reinsurance carriers. So it kind of begs a question about how vulnerable the market might be to systemic shocks and or a sudden withdrawal of a key reinsurer.
I think it is very vulnerable at this stage, because again, when you talk about the lead markets, they're so few and far between. Should one of them leave, all it takes is one very large cat event to scare management of, say, Hanover or Liberty to go, actually, let's just leave the class. And all of a sudden you have a real capacity crunch. I mean, that could create opportunities for people to step up and become leads. At the moment, many of the following markets are quite reluctant to take that role on, which is quite frustrating for us.
You talked before about the new syndicates at Lloyd's that are starting up at the moment, and then the pipeline of several more that we might see within the next 12 months. But there's no comparable list of reinsurers.
No, there is, but they all come as followers. So what we've seen is effectively there is a limited number of lead markets which are very much controlling the conversation, and lots of specialty seeking reinsurance capacity coming to the market. The issue you have at the moment is there's probably about 1,000 contracts, across the class when it comes to reinsurance. Those are all controlled with a very few handful, which basically means as the market grows and there's more contracts, but the leads are not increasing in numbers, service quality is dropping.
Systemic shocks, what could that be in reality? What sort of example event could we have in mind for what might cause that?
So the one thing that the market always struggles with is fraud. So the one thing you cannot underwrite for when you look at credit risk is a fraud risk, because it's nowhere in the data, right? Take Enron, for example. No one expected an Enron situation to arise. So that could lead to very large losses in the market, which are unexpected, and that could have a trickle-down effect.
So where can you have a fraud that's not just touching on one transaction, but it's like a macro level going to be a systemic shock?
So the market is quite concentrated in specific sectors, predominantly retail and energy, where insurers and reinsurers have large exposures to a handful of companies. Let's assume one of these companies were committing fraud, which was not picked up by the underwriters. You could have a very large loss across various underwriters and reinsurers, which could be seen as a catastrophic loss. We're talking
like
hundreds, close to a
Enron
billion.
scale fraud event.
Exactly,
Yeah.
exactly. And that's one thing that none of the underwriting models are still able to deal with, because there's not yet any early warning signs of a potential fraud. We're talking about AI and all of that. I don't know. That's the verdict is still out there. It would be interesting to see if something comes up of it.
What about cyber as another potential?
So cyber is an interesting one because the way the product is structured at the moment, cyber is included. So if you look at many classes in Lloyd's or just insurance generally, they exclude any cyber losses.
Mm-hmm.
Our class explicitly includes cyber as a cause of loss. So if there was a cyber event that led to an inability of a counterparty to pay, that would be included. Now, if you had a large cyber outage or cyber event, if you will, that then hit lots of multiple companies.
So maybe a payments provider or an exchange, someone that operates as between counterparties.
The one I always think about is, should the SWIFT system come down?
Right, okay, yeah.
So if SWIFT basically shut down and for a week there's no payments transfer globally, full stop, what will happen then? How many companies can survive having no money going in or out for, say, a sustainable period of time? At what point does the lights go out? It's these very, if you will, extraneous factors that no one is really monitoring or thinking about that could just really create a shock in the system. I mean, if you think of any large losses that the market suffered, it was always the unexpected. Right? It was always something no one ever thought about. I mean, who would have kind of foreseen the global financial crisis? Who saw COVID happening? Who expected Russia to invade Ukraine? I'm sure some analysts did, but as a whole, we thought it was not going to happen. So we're sort of sitting here thinking, what's the next big event and how will the market sustain that? And to the early point about concentration, if there's not enough players in the market and there is a big systemic event that scares one of them off, will have wider implications for the market as a whole.
Hypothetically, could a large-scale cyber event trigger a systemic risk level failure within this space?
It definitely could. I think, if there was a targeted cyber attack on, say, a specific country, that could lead to a systemic loss. Let's say there is a cyber attack attacking all Nigerian infrastructure. Nigeria is one of the largest exposure to the markets, being a natural resources rich country. I think population was about 150, 160 million people living in Nigeria nowadays. It's a growing economy, lots of exposure out there. If there was a targeted systemic attack on Nigeria, you could see very quickly lots of defaults. But it's not just that, it's across the whole supply chain, right? So Nigeria sells to other countries, or other countries are buying from Nigeria. So before you know it, you could have a bit like a spider web just spreading across, say, Western Africa, with countries close to Nigeria suffering an indirect knockoff effect because of an attack on a particular infrastructure. If you think of just global supply chains, everything is interlinked nowadays. So even a targeted industry or regional attack will have far-reaching consequences that probably most people don't necessarily realize until it's potentially too late. So there is that systemic, if you will, or inherent risk that, well, just the same way if you have a hurricane hitting a specific port, preventing shipments of goods, and all of a sudden, chip manufacturers out in Taiwan cannot ship the chips back to the US factory to then ship the TVs out to the Europeans. There could be all these links in the chain that are very difficult to track until the event actually happens.
Going back to sort of the geopolitical mood music, and what are some of the quiet geopolitical shifts that we've seen that could have outsized effects on political risk insurance in emerging markets?
So I think one of the issues, or one of the big question marks we have, is how much does the US government want to keep on playing on the global stage? There is a clear shift away from engaging with the wilder world, right? The US is retrenching, it's America first, it's focusing on internal politics rather than external. One of the implications of such was the defunding of US aid. So Trump, I think it was an executive order he passed, effectively said, we will cut funding. That's an example of where you have, if you will, the ally of the West or the world's police now pulling out of many emerging countries. So US aid was instrumental in having soft power across sub-Saharan Africa and Asia, where you at least had US personnel and government officials on the ground, right? And whilst obviously they had an aid element to it, It was also a case of picking up intel, having soft influence, and maintaining a dialogue with many of the governments of the emerging markets. With them leaving or pulling out, you're going to create a power vacuum. And when there's a vacuum, somebody's going to step into it. So the question is, who is going to take that role that USA played previously? Is it going to be the Chinese? Is it going to be the Russian? Is it going to be someone else altogether? We don't know, but you've definitely lost one of the geopolitical influences in the toolbox that the West had.
And what would be the effect for the political risk insurance business?
If you think of risks written across sub-Saharan Africa, there was a clear shift in recent years away from Chinese manufacturers and Chinese funding back into the European fold and to the Americans. We've now effectively withdrawn back out of Africa. So, does that mean you're going to have less business going into Africa because there's less of a soft power influence behind the scenes?
I read something the other day that said that US investment in sub-Saharan Africa is only about 10% of Chinese, I think, already. Something along those lines. So we're already there, aren't we?
Well, I think, the US was never really a major player in sub-Saharan Africa. They tend to stick to their backyard being Latin America.
Mm-hmm.
But similarly, if USAID is retrenching from Latin America, who's going to step in there? Are the Chinese going to play in the Americans' backyard? That's the question. Africa has traditionally been the realm of the Europeans. If you just think on colonial times, most of Africa, with the exception of a few countries, was part of a European empire at some point. But there's been a clear pushback against also the colonial old European powers and going into the Chinese sphere of influence. And it's quite interesting to see the way China thinks about exerting influence across natural resource-rich countries.
Yeah.
The Chinese are coming both with the infrastructure, the engineering, and the financing. So they come with a whole package. And it's effectively, not necessarily funded at a loss, but they're offering very cheap funding to these government projects that it's difficult to turn down if you're an emerging market.
And that's about all for another episode. I hope you found that wide-ranging conversation as insightful as I did. I have several episodes lined up for a busy September, so you can expect discussions about kidnap and ransom, aviation war insurance, as well as more from the world of credit and political risk. Thank you for listening. I've been your host, David Benyon, and I'd like to thank my wonderful guest for this episode, Eran Charit, Senior Broker at Lockton Re. Production was by Peter McGill, and my cousin Lawrence Durkin made the music.